Good afternoon, everyone. We will start this stock Durbar session in another 30 to 40 seconds. Good afternoon, everyone. Welcome to Stock Durbar with team MarketSmith India. Uh, I'll be starting this session by looking at key indices, Nifty and other key indices. Then we'll move on to your stock specific queries. In this session, we have our head of research, Mahesh Joshi, also joining us, and also my colleague Wokar will also be joining this session, and with three will taking the session forward. First, the disclaimer is this is a standard disclaimer across our webinars and podcasts. Registration granted by SEBI, membership of BASL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investments in securities market are subject to market risk. Read all the related documents carefully before investing. With this disclaimer, we'll start this session. First, we'll look into Nifty's daily chart. Today's candle is also updated here, but only thing is volume is not updated. But in the today's trading session, Nifty closed higher after 2 days of decline. And as you all know, Nifty has been hovering around its all-time highs. And in the last two trading sessions, we have seen two distribution days, back-to-back distribution days. That is a sign of a slight concern. Distribution day is when Nifty declines 0.2% or more on volume higher than the previous session. That indicates fresh selling or selling pressure, higher selling pressure in the markets. So it is very important to track weakness in the market, especially when the market is in confirmed uptrend, because we never know when the market is going to top out. So from here, we'll give importance to distribution day count, and currently we have observed 4 distribution days on the Nifty index. And if there is in further accumulation of 1 or 2 distribution days, and by the time if the Nifty breaches this yellow green line, that is a 21 DMA, we might change the market status to uptrend under pressure. Uptrend under pressure is the next stage of our market status, where our additions to portfolio are limited, and within the existing portfolio stocks, we'll be looking out for stocks which are moving sideways or which are lagging or which are underperforming the market. And if there is any breach of short-term moving average 10 EMA or 20 DMA, then we will exit those stocks. And adding stocks to portfolio in the after under pressure will be very few because of elevated distribution day count, and only stocks which have very strong parameters or ratings, and if there is any strong breakout only we will consider. But in the confirmed uptrend, most of the stocks or which are breaking or which are giving alternative buy points will also be considered. Currently, we have a good adequate number of stocks in portfolio. That's why we have not taken fresh positions, even though we have observing or we are discussing few stocks which are giving very good entry points. And from under pressure, the next stage will be downtrend when the distribution account further elevates to 6, 7, or 8, and if there is any breach of 50 DMA, then we'll change the market status to under downtrend. but that is a very long way going forward. Currently, uh, markets are holding up. Apart from the last two trading sessions, we have seen good amount of uh, consolidation, at least in the Nifty index. But if you look at other broader market indices, you would see how the markets are moving. This is a Nifty mid cap 100 index. Today's action was also very good in the mid cap index. That candle is not updated. We have only yesterday's candle. Today's candle will be updated around 6 o'clock in the evening. But today's action was very constructive if you have followed, and Nifty mid cap has closed at a new all-time high, a very positive sign. And during this rally, you can see it has clearly traded above its moving averages. At one point of time, it tested its 21 DMA, but it found very good support at that 21 DMA. So going forward, in this index, this level is going to be very crucial. And if that level is breached, and if there is any addition of distribution days within the mid cap spaces, then we'll change that mid cap index to rally under pressure. And this is the internally stored or maintained sheet. You can see here all the sectoral indices and mid cap, small cap, broader market indices, including mid cap and small cap, are in rally. This indicates a very strong or broad based buying happening in the markets. And these two columns, if you see, all these indices are also clearly trading above their moving averages, 50 DMA and 100 DMA, 200 DMA, sorry. So this shows that the rally which is happening in the markets is not a concentrated rally to one or two sectors. It is more of broad-based and it is across the sectors, starting from reality to auto, metals, energy. Everywhere we are seeing a very good amount of buying happening into the markets. Moving on to other major broader market index, that is the small cap index. Similar action in this index as well when compared to mid cap. 21 DMA support similar to mid cap index. And today's action was also very constructive in the small cap index. It closed at a new all-time high this index. So both the broader market indices, mid cap and small cap, are doing pretty much the same. Both have closed at the new all-time highs. Both are finding good support at 21 DMA. So going forward, this level is going to be very crucial for both the indices. And if there is any breach, definitely these indices will be kept or downgraded to under pressure. If you look at some of the key sector indices, starting with Nifty Banking, which has very good highest weightage in the market. Nifty Bank has also made a new all-time high recently, but in the last four trading sessions, you can see there is some kind of a profit booking happening, and it came towards its 21 DMA. And if you look at this candle, that is yesterday's, it found support at its 21 DMA. So this level is going to be very crucial for most of the indices because that is the shortest moving average which we track or which most of the analysts track. And the distribution day count is at 2 in the bank index. So it's very early stage to say the selling pressure coming into the markets. But when this 21 DMA is breached, we can expect one or two distribution days adding to banking index as well. Moving on to next major index, that is Nifty IT. Out of these sector indices, we can say one of the slightly underperformer. You can see even though it made a new all-time high for the last 10 to 15 2 weeks of trading, there is some volatility coming into this index. and it breached its 21 DMA as well in the yesterday's session. And if you look at distribution day count, you can see here count is at 5. So among the sectoral indices, it has the highest number of distribution days. So if there is one or two additions of distribution, I will definitely change the Nifty IT or will change the Nifty IT market status to under pressure. We'll look at a couple more of sectoral indices, and then we'll move on to your stock specific queries. Nifty Pharma has doing very good, especially in the last two trading sessions. In the Nifty or broader market indices were under pressure or under selling. This index has outperformed or more traded in the reverse direction, especially in the Tuesday session. It closed more than 2.5% higher, and in the yesterday's session, 0.6% of gain. On these two trading sessions, we have seen Nifty adding a distribution days, but this index clearly uh, moved in a reverse direction, giving support to the markets when there is selling pressure among other indices. And the volume is also been very good in this index, which is a very positive sign. And it is also trading at new all-time highs. So majority of the indices, as we talked about already, are trading at new all-time highs. So definitely the markets are moving higher and higher, uh, which has support from all the indices, not just one or two indices, which is a very positive sign. Nifty Auto, it might be repetitive, but as indices are trading in such a way that the patterns are looking very similar. Nifty Auto has also traded or made a new all-time high recently, but in the last three trading sessions, we have seen some profit booking happening in this index, and this index has a good support at its 21 DMA, very similar to mid cap and small cap indices. And going forward, this 21 DMA is going to be crucial for the index. Let's see what is the distribution day count for the Nifty Auto. It is at 2. So it's still in very early stage for the market status to be changed to under pressure of within the Nifty Auto. I think we can start with the queries now, because if there is any sectoral specific query within the queries, we can discuss by then. But what the theme which is there is very similar. We are seeing most of the indices, sectoral indices, broader market indices making new all-time highs, and most of the indices have having good support at its 21 DMA, and the distribution day count is around 2 to 4. So if there is any further distribution of around 2 or 3 more trading sessions, we will see some kind of pressure coming into the markets, and we will also be changing market status to under pressure by then.
Rachik and Mayuresh, sir, just one more sector if you have not covered that, because reality was really doing very well. So we can just cover Nifty reality and then start with the queries.
Sure, Miles. Yeah.
Thank you.
Yeah, as mentioned, this sector has been doing very good. You can see here it has made a new all-time high, and in the last 2 weeks also there is good amount of uh, price gain within the index, and the index also has good support at 21 DMA, and we'll see what is the distribution day count in the Nifty reality. It is at 4, but still it is manageable because 21 DMA is not breached. So yeah, if there is any one or two distribution days in the Nifty reality also, then we will consider. Otherwise, we'll continue to stay in confirmed uptrend, and will stay invested into stocks. If there are already lots of stock specific queries, for the benefit of everyone, we'll be answering a few stocks so that we'll be able to uh, ed- uh, educate here everyone that about our cancel methodology. It's not about the number of stocks which we pick, but we try to pick few stocks and try to analyze from the only lens what are the parameters we look at and what is the methodology point of view per se. We'll try to explain. So if there is any of your stocks not getting answered, please don't worry. Our motto is to educate here about the methodology, not about talking about any specific stock.
Raj Vakaria, I'll start with the queries.
Yeah, okay.
Yeah, can you give me a chart for Bank of Baroda? We'll take some PSU banks first. As you can see, the stock is currently 8% extended from pivot. So not in the ideal buy zone, but what Raj is trying to point out is the superlative performance that the PSU banks have been showing, and Bank of Baroda being one of them. If you look at the 6 to 7 quarter results for the bank, it has been very good. And similarly, with on the price front, price volume action front as well, the bank has been in a lot of momentum. If you look at 24 and 25 estimates in terms of consensus estimates, even that is in a high double-digit growth in terms of EPS looks very good for the stock. Plus, fund holding is also increasing. Currently, the stock is not in the ideal buy zone and cannot be bought at this moment. Someone who's holding can continue to hold so as the stock is trading 8% above the pivot. Can trail your stop losses to the green line, that is the 21 DMA. And if probably the stock touches the green bar, that is the ideal profit booking zone, considering your risk appetite, can trim it down as well, the position. The next would be South Indian Bank. Yeah, thank you. Yeah, it's good. The only thing, the issue with this is, I mean, the price strength for what we seen for Bank of Baroda is probably missing with this stock. And can you show me the last 4 5 quarter results as well? Maybe we can get some insights from there. Yes. So as you can see, why the EPS rating for the stock is not that good is because of the fluctuation in EPS and in terms of the NII for this bank, and that is why maybe the asset quality for was not that great, and that is the only issue where the bank is facing at this moment. And PSU Bank as a pack has been doing well. So try to look at leaders and not at the laggards. So probably the stock is probably looking at as a laggard at this moment. Even on the base formation wasn't that good. At the breakout, you can see there wasn't that great volumes. And in terms of like the build up to the breakout, the build up to the breakout wasn't that good. No good accumulation coming in, and that is why you can see the breakout failing. And the good part is that the stock found support near the key moving averages. But if you look at -2% in the last 16 days, where overall the Nifty index, even the PSU Bank index, has been very good momentum, then this stock has acted as a laggard. If someone's holding the stock, can exit out of the stock if the stock reaches the 21 or the 50 DMA, considering your risk appetite on higher volumes, and move your positions to market leaders. The next stock that we can look at it is, just give me a second, is GMDC. Yeah. Thank you. The only thing that I can look at this moment is two things. The EPS strength 15 is very poor because of the last couple of three-quarter results. But the other thing is that the stock is 151% extended from pivot. So someone who probably bought it at the last breakout is sitting at a very huge gain, which is a good sign. I mean, after consolidation in the last couple of sessions, the stock is again trying to move up. What would probably advise is that, the 51 and the 20 DM is kind of clustered very close at this moment. So can trail your stop losses there. If those key moving averages gets breached, then probably trim down the entire position or a part of the position depending upon your risk appetite. Can you show me the extension from 200 DM? So yeah, extension from 200 DM is not that high in terms of 77%, not in high triple digits at this moment. So can hold, but if some key moving averages gets breached, then definitely can try to book out and look for other positions. Similar queries we had, just a second, was NCC and NBCC. So NCC, yes, it's a model portfolio stock. And disclaimer, it's a model portfolio stock. We've been holding this stock since last 1 month or more. And as you can see, after breakout, the stock has been consolidating. If you look at today's session and the last couple of sessions, it has been very positive. As you can see, the stock has finally been climbing, and it's found support around the 50 DMA and the 100 DMA. And just look at the last couple of sessions. The stock has moved higher on above average volumes. That is signs of accumulation, which is a very good sign. We are pretty confident about the overall business aspect and the fundamental story of the stock, and hence it was added to the model portfolio. And if one had added with us, can continue to hold so. And at this moment, in the last couple of sessions, if you look at it, the stock is definitely showing signs of strength. The last one I'll take is MBCC. If you look at the stock is 95% extended from pivot. Very, very good run up from the last breakout. That was a cup base. And new positions cannot be taken. That's pretty well extended from some key moving averages as well. And even extended from the pivot as well. Someone who bought it at the breakout can continue to hold, considering the stock is kind of making new highs. Today's candle is kind of a downside reversal, not big reversal, but small reversal on above average volumes. So the stock can be a little jittery, but observe the 21 DMA. The stock has found support at the pretty much good support at the 21 DMA during its run up. Couple of times at the 50 DMA as well. But at this moment, keep the 21 DMA. If 21 DMA is breached and breached on above average volumes, can at least trim down positions, if not exit out the positions completely.
Thanks, Wakar. I'll take few queries now.
Yeah, thank you.
I'll start with Durbar. The stock had given a breakout in the month of November and December starting, and from there it has rallied nearly 60% in 25 trading sessions. So very strong breakout, one can say. It has also hit power to pivot. Stock advancing more than 20 to 25% in 3 weeks of breakout is considered as a power to pivot stock. And from there, it has advanced another 20 to 25%. So Still, there is good strength in the stock, and the volume bars are also suggesting the same. Still, there is good amount of fresh accumulation happening in the stock. And let's look into its earnings and few other data points. Earnings is slightly not so constructive, one can say. That is the reason EPS is at 45. That is majorly because of inconsistency in the numbers. You can see one quarter it has reported good numbers, and the next quarter it has delivered degrowth. So on the index front, it was not done good, but on the price action front, it has done very good. Number of funds section has also not moved much. It is trade around 96 to 98 funds for the last 4 quarters, so not much action there also. But RS rating and other technical ratings, ABD rating are doing very good. That is because of price volume action. RS is at 91, and RS line, if you observe here, has been consistently hitting or forming blue dots, very constructive sign. ABD rating is highest at A plus. That is because of these blue bars, above average blue bars, indicating or showing good signs of accumulation happening in the stock. So if you are already holding this stock, if your question is to whether to hold or exit, uh, I would say you can continue to hold, and also looking into market structure and elevated distribution account, you can be slightly or partial book your profits, and you can continue to hold the remaining portion and see how the volume section is performing. If the stock falls on higher volume, you can start trimming further your positions. 21 DMA is still 26% from here, so it's a very long journey going forward. So if you are waiting for a 21 DMA breach, most of your profits will also be eroded by that time. So one can start using exponential moving averages, 10 EMA or 20 EMA, so that your profits are maximized. We have one YouTube query, that is RVNL real, because there's a lot of action happening among the railway stocks, RVNL, Railtel, and a few other stocks which are related to railways. You can see here the stock is forming a stage 6 base formation, and which is very rare. Normally, you'll see stocks forming stage 2, stage 3 bases, but a stock forming stage 6 is very rare. If you understand about how the stages are counted, you'll be knowing. This shows that in the last 6 breakouts or 5 breakouts, the stock has not breached the previous base low. That is the reason it has continuously, the base count has been increasing. And currently, it is not having enough fuel to take the stock forward. That is the reason it is not able to break out very decisively from here. But this is what happens from stage 4 or stage 5. Starting with stage 4, it is very rare for a stock to break out from a late stage base and give another 20-30% from there, because previously it has already given some good returns. And if you are expecting further returns, it is very rare to happen. But stocks like this, you never know, can continuously give good set of returns depending on how the railways in India are doing, and reforms made according to from the government side related to railways. Lots of action is happening there. So manufacturing and new lines, electrification of lines, and bullet train programs. So there's a lot of infra development happening among the railways. So these stocks will be limelight going forward as well.
Rachikar, since we are talking railways, let's also take Railtel, because Ankush had a query there.
Sure,
So
sure.
we will finish this railway stocks at a go. And as Rachikar was pointing out, I think there is a lot of structural investments that are happening in railways. Uh, Obviously, the kind of capital commitment that the government has given in terms of railway lines, additional railway lines, in terms of more rail station coming, more trains coming, rather, as well as the completion of the dedicated freight corridor. on the western front. The eastern front is almost done and dusted. I think there is a lot of activity which can get attached to this entire infrastructure, rail infrastructure space as well. So apart from this, you've obviously seen the wagon makers who have moved significantly higher. Jupiter, you've got Titagar, you've got Texmaco Rail, because large part of more metro orders coming their way, more designing happening in terms of freight wagons as well, as the dedicated freight corridor takes complete and final shape, is all that is expected to come through. And there is also the expectations of the anti-collision system because of the unfortunate accidents that we probably witnessed in the past few months. We've got stocks like an HBL Power as an example, the Kavach system which will get implemented. There is also the the railway traffic signals infrastructure related around that, digitalization around that. So I think there are all these structural themes because of the government capex. And this all gets followed also in terms of power as an example, right? Surprising, I'm not seeing too many power queries today, but thermal to renewables is an entire structural story over the next 7 to 8 years. And that is going to get played again, like railways, through the entire power infrastructure. Generators, transmission players, you've got the EPC players also, uh, storage makers, you've also got energy storage guys, battery makers, and therefore this entire theme which probably is coming through on the government capex side, whether it's power, whether it's railways, whether it's defense, I think the structural capex is going to continue for the foreseeable future. The order books are extremely heavily loaded for the next 4 to 5 years. The only question that now remains is that a lot of these stocks are in late stage basis. So any miss in terms of numbers, or if there is some element of execution miss, because to a certain extent, what capacities all of these guys have can suffice for the next 2 years, 3 years. But they need to expand their capacities quite meaningfully. And for any reason whatsoever, if the execution probably falters for a quarter or two, it can succumb to a lot of profit booking purely because of the late stage base and the valuation discomfort that happens because of the late stage base that they are trading at in terms of pure price action. So what Vakar and Rajshekhar are trying to tell you, right, through the starting of this session is A, how the DD count is getting built up at the index level. What we've always pointed out in our level 1, level 2, are a lot of sectors showing stress apart from the main index. If those sectors are showing a lot of stress, are leaders showing some element of downside risk? Are you seeing a lot of stalling into the market? Are volumes relatively higher, which are getting reflected for all reasons of domestic and international cues that are coming through? And therefore, all these things need to get monitored very, very closely. The 21 and the 50 DMA in the current market scenario becomes extremely important. And one user had asked a particular question on how to buy, when from, where do you actually buy in terms of their extensions from moving averages. So ideally, I think what we call as a pivot level, which is the ideal buy point as per MarketSmith, as per our cancel-in methodology, is where the stock is actually making a breakout from the base that it has created. Now, what is a base? The base is nothing but a pattern that it has probably created, whether it's a double bottom, whether it's consolidation, whether it's a flat base, whether it's a cup with handle. So any of these patterns, as they are getting formed, and typically if you would have heard us in our level 1 or level 2 webinars, when a pattern or a base is getting formed, we divide that base or the chart into two parts, left and right. The right side of the base is where the chart becomes far more constructive. So all the action that happens for the first half, which is when you break the chart into right in the middle, the left hand side of the base will obviously show a lot of volatility. Volumes will be awkward, upside down. The volume activity will be high, low, and therefore the price action might be high, low. But the right side of the base, the constructive activity, the constructive action becomes well defined. And therefore, if the stock is in the right sphere, in the right sector, in the right domain, with the leadership trade that it has, volumes start drying up. And as it starts entering or coming close to the pivot, which is the buy point, because if you observe that we've got a pattern recognition system onto our own proprietary system, which recognizes the kind of pattern that it is getting made. And as it's getting formed, as volumes start picking up, you will get all your filters in action. The blue dot list is a key filter. The nearby point is a key filter. the near pivot stocks is a very key filter. So all these filters will start having those actionables put in. And obviously, we need to peg on our EPS and RS ratings that come through on the quality of the stock that is coming through, which gets reflected to these ratings and rankings. So if it's matching the criteria, obviously the other criteria, including market cap, we don't select stocks which are less than 1,000 crores market cap, enough liquidity, etc. There are all those checklists in the tab that is available to have more hygiene checks done, to have a qualitative aspect on the stock as well. All those aspects, once they are done, an ideal thing what we have observed over historically, whether it's the Indian markets or global markets as well, the 21 or rather the 50 DMA is around 7-8%, which is the ideal stop loss as per the O'Neill and the Cancelim methodology from the exact buying point at the lower end of the base. So ideally, if the stock is in stage 1 or stage 2, the 50 DMA would be close to 8%, and that's an approximation for most cases where that stock is actually breaking out at the lower end of the pivot, which is defined as 0 to 5% for us to have that ideal buy range. But at the lower end of the pivot, the 50 DMA, ideally, what we observe very, very strongly at O'Neill and in Cancelim should be 7 to 8%, which is the ideal stop loss as well for the trade stock investment that you have. So to answer your question, this also takes care of a lot of moving averages. And what Vakar was probably mentioning, right? He just mentioned for one stock, GMDC, if I'm not mistaken, where the 200 DMA live. And therefore, the observation also has to be where the 200 DMA is placed. What we've also observed is that after a huge run up, the late stage base that Rajshekar was mentioning also, if the stock runs up too much and too fast, and it's extended, say, 125% from the 200 DMA, some stocks, like we are in the market right now, might still continue in their frenzy on that up move. But to define that is something that your stock should have an actionable in terms of the sell watch list if it's 125% from the 200 DMA. And therefore, then your ideal stop loss in such scenarios should be the closest moving average, either the 21 or the 50, if they are very close together. If that gets breached on heavy volumes, that automatically becomes your exit signal. So I'll continue. I mean, I wanted to just put a couple of pointers in so that we probably go up the learning curve as we discuss all these things together. And therefore, let's move on to the other aspects in terms of discussions. Rajshekar, there are a few queries on the fertilizer space, so we can take NFL, RCF, and Paradeep phosphates, if I'm not mistaken.
Okay, sure, Mahesh. Yeah, we wanted to discuss about Railtel as well. So this is one of our portfolio stock, and it has done very good. Currently, we are sitting at almost 40% gain, belonging to railways, which already discussed by Mahesh. So this stock has been getting good investments. Good accumulation has also been happening. After breaking out, we are seeing good amount of buying happening within the stock. That is indicated by its ABD rating as well, A plus, which is the highest, uh, majorly because of strong volume action and accompanying by strong price action. Technicals and both technicals and fundamentals are looking still intact. So we continue to hold it, and we'll see if there is any selling happening in the overall markets. And if this stock also succumbs to that selling, we'll start trimming our positions and we'll advise the same to our investors or our users as well. I think we'll move on to some of the other stocks, fertilizers and chemical stocks. Starting with RCF, this stock has broken out recently from a stage 3B base pattern, but after breaking out, it has been very volatile. And within the base as well, we have seen, as mentioned by Myris also, the left side of base, if you observe here, it's very clearly pointed by Myris here. There is very huge volatile action happening here, and the volume action was also not constructive. But the build up to the pivot is very good. When the stock consolidated at the lower end of the base, the volume died up, a positive sign. And when the stock building up towards pivot, the volumes have picked up, and the breakout volume was also very strong. And after breaking out, we have seen some consolidation, but one or two sessions of strong selling. That is the reason it tested its 21 DMA. But this happened for the most of the stocks we have seen good strong selling in the mid cap, small cap indices as well. So similarly, this stock has also succumbed to that selling pressure, but it rebounded very strongly from there, and the volume has also picked up from there. And currently, it is trading in the ideal buy range. This green highlighted area is the ideal profit booking. I'm sorry. So whenever the stock comes here after breaking out, we try to start trimming positions because it has advanced 20 or 25%. So it's okay to partially book profits and move on to other stocks which are still break are showing good signs of strength among the stocks which are forming base patterns or breaking out from the base patterns. Next is Paradeep Phosphate. This stock has broken out very recently, but the ratings are not so good. Both EPS and price strength are still lagging, but the breakout is looking very good in terms of price volume action. But keeping in mind about the ratings uh, and the current market structure, we have seen lots of stocks breaking out which are having strong ratings. So it's better to stay invested in those stocks which are having good ratings rather than moving on to stocks which are having poor ratings. But if there is any strong factor, in factor, which we call in the canceling, might be related to anything about the company, any new change in terms of operations or management, definitely you can take a aggressive entry. You can consider those stocks because EPS doesn't change very often. It changes very rare. So if you are waiting for the stock to first the stock to EPS to turn strong, it will be very long period. So considering other parameters, technical parameters, you can take a call. And this stock currently is extended from the buy point. It is almost 9% from the buy point. So it's not in an ideal buy range at the moment. It's not advisable to take a fresh entry. But if you have taken position at the breakout, I can continue to hold it. And let's see how the stock consolidates going here. If this setup continues to another 2 to 3 trading sessions, definitely it will move. It will hit power to pivot, and it is better to stay invested in those stocks because we might see the stock going to be a very big winner or giving a gain of 50 to 60% of gain.
Thanks, Raj. Vakaria. I'll follow up with the queries now. So can you give me the chart for Coal India? So again, good selection of breakout if someone had done in terms of you can see from the last breakout. It was a very clean breakout. Plus, if you see post the breakout, the stock has rallied more than 55%. And the beauty of the rally is that the stock has never breached its 21 DMA. The stock has always found support at the 21 DMA, which is a really good sign. And still, even at this moment, I mean, fund holding is constant and slightly declining, but can be taken at this point considering the huge market cap that the stock holds. And overall, EPS strength and price strength is fair, but RS line is still kind of moving higher, which is a good sign. And if you're holding this stock, can continue to hold so. I mean, no major signs of reversal at this moment. I mean, what I can see, uh, as Mayuresh and even Rajshekhar was pointing out, when the stock is that much extended from the pivot, when you have already enjoyed the gains to an extent of more than 50%, there can be some kind of extensions. But overall, the extension from 200 DMA doesn't look that big or that absurd at this moment. So, 21 DMA, as the stock has always respected the 21 DMA, so the 21 DMA can be kept as an ideal stop loss or a trailing stop loss for this stock at this moment. So if that gets breached, uh, can at least trim down on the profits. because going forward, I mean, the stock is looking like it's going to make some new highs. So, I mean, can enjoy the run, keeping the rules in mind, that is the stop losses in place. The next one we look at is ICICI Bank. Thanks, Raj. So the stock, I mean, in terms of even the ratings have been declining, and as you can see, the stock is delivering on numbers, but I mean, maybe it would have been getting beaten down on the estimates that it would not be being able to reach the consensus estimate front, and that is why the stock is getting beaten down. As you can see, even after the breakout, the stock has declined. It has declined on above average volumes as well. The RS line is declining as well, and the stock has been declining on good volume, so it's not a good sign. Someone who's holding the stock, I mean, can keep the 50 and the 100 DMA, which is clustered at this moment, as their stop loss line. If the stock doesn't respect the 50 or the 100 DMA, then can exit that stock, because the overall ratings is getting deteriorated for this stock. Mm. The next we can take is KEI, then signed. So this stock has been, I mean, an ideal candidate of a re-breakout. I mean, someone who've been following us on the canceling 1 and 2 webinars. I mean, we've been knowing what I'm trying to speak in terms of, if we speak, look at how the breakout happened. The first breakout wasn't successful. I mean, it was not even an ideal breakout as well. Even the stock moved lower from the pivot only, and maybe the volumes would have been lower as well. Raj, can you show me the volumes? Yes, so if you look at the volumes as well, the volumes are not that great. And after trying to consolidate around the pivot, the stock came under selling pressure, breached the 100 DMA as well. And from there, when it rebounded from the 50 DMA, the 21 DMA, you can see volumes coming in, uh, stock creating alternate buy points, and even from there, the stock re-breakout. And when the re-breakout happened, the re-breakout was on very, very good volumes. So once that happened, you can see the post that re-breakout, the stock moved 23% higher from the pivot, and it is currently in the ideal profit booking zone at this moment. So depending upon your risk appetite, if someone is holding on to the stock, maybe, I mean, ideally buying at the re-breakout and now holding, can continue to hold so, but can even partially book on the profits as well. Why I'm saying continue to hold? Because the stock is still showing signs on momentum. Even today's stock moved more than 3.5%, closed in the top quartile, and with volumes higher. And even fund holding for the stock is increasing. The momentum in the earnings for the stock is not slowing down. Overall, the wires and cables industry that the stock is in, or the company is in, it's a top three player, and the market share for the stock has been consistent, is strong and consistently improving as well, just behind Polycab. And even in terms of the ROE, or the return on equity for the company, is very strong at 18%. So can continue to hold, but I mean, look at your risk appetite. It's there in the ideal profit zone. I mean, 25%, 50% of the profit can be booked, and can trail the remaining position with your 21 DMA as your stop loss level, or your trading stop loss. The next, yeah. Thank you. Thank you. So the mid cap IT stock, and as you can see, the mid cap ID and the small cap ID have been in flavor for the last couple of months, 2.5 months, as one can see. And the stock has broken out from stage one consolidation base, and with the breakout, blue dots were happening. So that is the RS line was touching new highs. Even one can see all the ratings for the stock have been very good. Plus, the shareholding for the stock have been improving. I mean, number of funds that are invested in the stock are improving, which is a good sign. And post the breakout as well, the stock is showing good signs of accumulation, which is a good sign. And when the stock is declining or probably consolidating, just look at the volumes. The volumes have dried up, which is a good sign. And maybe going forward, the stock might find support near the 21 DMA. And even if volumes come in, a new leg of bull run will start for this company, and which looks good. If someone is holding, can continue to hold, so keep 21 DMA as a trailing stop at this moment. And I mean, EPS for the stock is due in 21 days. That is, the Q3 results for the stock will be in place. If till that point in time, if the stock remains momentum, have a look at the company's earnings. Have a watch the con call as well, because what is the company trying to give in terms of the future guidance? All of that will relate to the price volume action going forward for the stock.
Thanks, Okar. I'll take the queries now.
Yeah. Okay.
I'll start with Shanti Gears. The stock has broken out from a stage one consolidation base very recently in the last week of November. But from there, it has been very highly volatile. In some sessions, it advanced 8%, and in the next few sessions, it had closed on the downside 4 to 5%. So this kind of stocks hit stop loss very quickly. Our stop losses are kept in very tight. So 6 to 7% fall in a single session will definitely trigger our stop loss. So that is one side of sign of concern when talking about Shanti Gear. Apart from that, the stock has been doing very good in terms of earnings. For the last 4 to 5 quarters, consistent growth was observed in terms of sales, 20 to 30% of consistent growth. And in terms of EPS, it is a clear outperformer, an average 30 to 40, 50% of growth in the last 5 quarters. So on the earnings front, there is no doubt about it. But only thing is, price action is not looking very constructive. There are few sessions of volatile action here and there. So on that front, it's very difficult for us to manage. But if you are already holding the stock, you can keep a 1 or 2% below its 21 DMA as a stop loss, and you can continue to hold it until that level is breached. Next is Federal Mughal. It's a very small market cap company. It's a market cap of 2,000 crores, so very less on the size of the company. And the base formation it is forming is a stage one consolidation, but it's a very wide and loose base pattern. It's not an ideal type of base formation. EPS is very strong, but the RS line has been declining and RS rating is on the poor side. So considering that, we will not consider this stock for our watch list. And there is long way for the pivot as well. And as mentioned, this is a very wide and loose base pattern. So on the base pattern wise also, it is not looking good. But if you have taken a position in this stock as so, you can keep it 200 EMA as a stop loss, which is 2.4% from here. A 1% below that level can be kept as stop loss, and you can continue to hold until that level is breached. But from our side, we do not advise to invest in these kind of base patterns, because you can see here it's very volatile, and you never know, in 1 or 2 trading sessions it can fall 10%, back to back 5% loss in 2 sessions will give a more than 10% of loss. So it's not ideal to trade in these kind of or invest in these kind of stocks. There are few YouTube queries also. It's better to answer those. We have been seeing ITI, which is very repeated. The stock has formed a stage 2 cup with handle base pattern, but prior to that, if you observe the last breakout, that is which happened in the September first week, it has been a very successful breakout from a stage 1 cup with handle. The stock has advanced more than 100%, and from there it has consolidated and formed another base pattern, that is the stage 2 cup with handle. But from here, it is finding some kind of resistance, or the stock is lagging on the fuel front. It is not breaking out on higher volumes. So we would like to see stock closing very strong. For the last 1 week, if you see, observe the daily candles. For the most of the sessions, it closed in the downside. That is, even though it closed in the positive territory, but on the trading range, it closed in the lower half, indicating a weak closing. EPS is very poor at 18 because the company has been reporting losses for the last 4 quarters consistently. Sales have been doing good, but that sales are on the sales front also we have seen some few quarters of inconsistency. So on that front, it is not looking good, but the technicals price volume action front, the stock has been doing very good. You never know, when the stock breakout from here, we can see another 20-30% gain, but it's better to stick to rules and invest in stocks which have good ratings and which has very good strong base pattern as well. I'll take next internet design area. This stock has been a very good stock for the last 1 year or so. Prior to this base formation, it has advanced pretty much very good, and it consolidated and formed a stage 1 base pattern, and the breakout happened on higher volumes, but the closing on the particular breakout is not constructive. We are at that the stock is at 9% from the pivot in 23 sessions, that is in a period of month. But we would like to see the stock continue to find momentum on the higher side and rallying 20-30% in a period of 1 or 2 months, because the overall market is doing that. Broader markets are also doing that. So we would like to see those kind of stocks. And if you are finding those stocks, and it's better to invest in those kind of stocks, because Slim methodology is a growth based methodology. And currently, whenever the market is in confirmed uptrend and whenever the indices are making new highs, our returns will also be on the higher side. So these are the periods we make maximum gains, and most of those breakouts in this period will also be successful, and mostly these breakouts will also outperform majority of the stocks. Coming to this stock, one can say, if you are looking for a tight stop loss, you can keep it at 21 DMA, which is 2.6% from here. But you are okay-ish, and if you're depending on risk appetite, you can keep its 50 DMA, which is another 11% from here as a stop loss. But if you keep 50 DMA, your profits will be eroded and you will be at a loss, because that is below the pivot level. Next is Century Textile. We'll take a couple more queries, and we'll call it a session. Currently, Century Textile is forming a ascending base. It's very rare to observe these kind of base patterns. Normally, you find a stage 2, stage 3 consolidation, or cup with handle, or a double bottom base pattern, but ascending bases are very rare to form. And ascending basis success ratio is very good. It has broken out in the today's trading session. It closed more than 12% higher, and the volume was also almost at a record high. So on the breakout front, it is a very strong breakout today. Only thing is EPS is very poor at 8, almost at the lowest level. RS line will improve from here because of today's session, and RS line has also formed a blue dot because of today's action. So going forward, if this momentum continues for the next couple of sessions, we might see RS line or RS rating improving to 75 to 80, and also stock advancing 20-30% from here.
Yeah, Raj, you can take a last query and then call it a day.
Yes, I think as mentioned previously, also we will not be able to answer all your queries, but whatever stocks we pick are picked in a very random, or if there is any specific thematic sectoral query, if you have, we'll be picking them. But don't worry, our motto is to educate or discuss about the methodology rather than talking about specific stock. So that you will also be able to take decisions on your own. Uh, so that is the overall objective of this session. And I'll take the last query, that is Nalco, and then we can call it a day. And if you are still, or if you are looking for a specific query to be answered, you can write to us on our mail. We'll take time to answer your query as well. I think we'll take JB Chemicals. The stock has broken out from stage to consolidation base. It's a very wide base pattern in terms of depth. You can see from 200 to 300, so 300 points of depth it had during the base formation. That is almost 20%. And the breakout has also happened a couple of times, but it was not successful. Current breakout is also not successful, but the stock moved 8% from the pivot. Still, it's a very long way to say whether it's a successful or failure breakout. But earnings is looking very good. EPS is looking very good. Is at 91, majorly because of a strong, consistent growth in terms of sales and EPS. RS rating, you can say fair enough, but not very strong enough. It is at 68. RS line has formed a blue dots. This is because the stock showed good signs of accumulation in a couple of sessions, especially in the yesterday's session and previous to that Friday of December. We have seen good accumulation happening in this stock. But as the stock is above that trading range, buy range, it's not advisable to take fresh entry. If you're already taken entry, and if you're looking to exit or whether to hold it, you can keep a stop loss at 21 DMA, which is 7% from here. And from there, if the stock breaches that level, you can exit. Otherwise, you can continue to hold and see how the stock performs. If the stock underperforms or moves sideways continuously, then you can book it at the market price and move on to other stocks which are showing signs of outperformance. I think with this, I think we have talked about most of the stocks and sectors which are asked in this webinar. Uh, I think we can call it a session, and we hope it was a enriching session. Ourselves, we feel it's very uh, the sessions like us. These will help us talking about stocks and our methodology, and discussing about our methodology is a very long step going forward. Thanks everyone for joining this session. And if you are feeling left out in terms of your stocks, always feel free to write to us on the email. We will take time and answer your queries. Thanks everyone for joining.